Welcome to the Lady Landlords podcast, where we empower women to gain financial independence through real estate investing. I'm your host, Becky Nova, founder of Lady Landlords. If you're ready to buy, manage, and grow your real estate portfolio, then let's get started. Welcome to this week's episode of the Lady Landlords podcast. I am your host, Becky Nova, founder of Lady Landlords. And today we are going to be talking with John Cohen of Turo Real Estate Partners, all about syndications. So John, thanks so much for spending your day with me. How are you?
I'm hanging in there, coming off a wedding weekend, it appeared, and we're doing good.
Good. Hopefully the hangover's not too bad.
Now we are rocking and rolling. With little 3-year-old daughter, you get over those quickly.
Yeah, or they're going to remind you very much of why you should not drink too much. So
yeah, one or the other.
Yeah. So if you're listening in and you have not heard of John Cohen yet, make sure to go and take a look. John and I did a syndications workshop a little while ago. You can actually find that on the Lady Landlords YouTube channel. But I wanted to make sure to really kind of capture some of this information for those of you that listen to the podcast. So if not, I'll make sure to put down the show notes, also the link to the workshop, so you can go learn more about some of the deals that John and I are working on and really dive a little bit deeper to it. But to kind of just get us started here, John, you already mentioned daughter, but can you tell us a little more about who John the man is?
Yeah, no, for sure. 35 years old, passionate about real estate in my prior careers, and I've been doing it for 10 years. When I left my other job, it was to focus on real estate. Married, pretty laid back, former baseball player in college, and I like real estate because it gives you a lot of flexibility. You could sort of dictate your terms on what you look for, and that's snapshot. Very big family oriented. And what you see is what you get. Sometimes it rubs people the wrong way, but that is what it is. Sometimes the truth is not always the best.
If you couldn't tell by John's accent, he's clearly also from New York.
Yes.
And John, I will say that I tend to get the same thing. You either love me or you don't, and you can kind of take it or leave it. So I feel like that's a very New York attitude we have over here. Maybe that's why you and I get along so well. But
oh, for sure.
But we are a very specific taste, right?
That's for sure.
Now, did you always want to be in real estate in some capacity, or was this something then throughout college that you just kind of fell into?
Yeah, no, fell into it is probably the best way to put it. I think, money motivated was early on graduating college. That's really where my head was at, is, what can I do to make a lot of money? Unfortunately, that's probably not the good why to getting involved in real estate, because you quickly realize it could be a little bit harder than you think, or maybe it just takes a little bit longer to generate some type of income. So I actually started in finance. I was good at it, but I hated it. And while I was there, real estate started creeping up, and I ended up buying some properties for myself, and then I found out that I really liked doing it. So now, going back, I mean, you could, my grandfather owned a ton of properties, and I saw things that probably helped me make that decision. But no, it was not like, born, raised, and this is what I wanted to do. Almost the opposite, and sort of fell into it just by reading some books and trying, and so far so good.
Yeah. What was like your first introduction then into the real estate investing world?
So the first thing I did, I think like most, was like, oh wow, let's fix and flip something, right? That failed miserably pretty quickly because you needed a little bit more capital. So I started buying tax deeds and tax liens. I bought properties for $350, and just learned a lot by see, feel, and touch. You buy something for $300, you make a mistake. Right? It should not ruin you. Exactly. So that's where I first started. It was just, stuff like that. I tried to pick areas that I was relatively familiar with. My brother went to school in Pennsylvania, so I looked in the immediate county, doing some research, found some places you can do it online. So I just tried to figure out, dollar for dollar, and what I knew little about real estate, where should I start? And that's how it started.
So the properties that you're buying, because I know this is a question we're going to get, the properties you're buying for a couple $100 were clearly not in New York.
No, they were disasters. Although there are places upstate New York and there are some auctions upstate where you can buy stuff for cheap, not hundreds of dollars, but thousands, low thousands. But there's a reason why they're priced that way. There's typically something really wrong with them.
Yes, I was just saying, clearly New York is actually a very large state. Whenever we say New York, most people do think of the city, Long Island, places that are going to be a little bit more expensive compared to the fact that we have a very large state with a lot of space, and we actually border Canada too, which means farmland. So, so yes, you could definitely buy things at very different price points in New York. But to your point, there's going to be a reason something's only going to be a few $1,000s versus a few $100,000. So, all right. So you got into these fix and flips. What was the biggest problem? You said that it just kind of failed miserably. What was the biggest issue that you ran into in that fix and flip?
The market we live in is very unique. I live out in Long Island. Every market is unique, but you have a lot of, similar to other markets today, a lot of competition from end buyers. Someone that's going to live there who should always be able to pay more than you can because you're not trying to make a profit. They're buying it because it's what they want. Add in a layer of it wasn't what I did bread and butter. I never fixed a toilet. I never fixed a roof. So it's like, okay, you call vendors, you call people, they give you prices. And then you're like, well, you hear all these war stories. Roof's going to cost $7,000. Okay, I'm going to put 13 in there because I don't know. So it was a mixture of not knowing and also the competition on the deals that I was looking at. You would go there, whether it was on market, off market, direct mail, cold call. Well, this person said they'd give me 500. I'm like, yeah, I'm not that person. So that's why it didn't work out. Now, full disclosure, was my effort 1,000% into it and where I wanted to make it what I wanted to do? No, it was, I was still working a job. I was still doing, I was still, I was in finance. I was doing that for, 16 hours a day. So it's like, okay, here I have an hour. Let's go try and find something. So it wasn't all my energy and effort doing it, but I was just coming up well short. And then, the areas I was looking, the prices were $200,000, $300,000, $400,000, $600,000. And it's, that's separate of a loan. You're going to have a lot more capital to do that than you would buy, I figured I could buy 20 tax deed properties for $1,000 each. And if I lost it, well, it's better than a house that's got taxes if I couldn't sell it or well in over my head. So it was just sort of a risk reward trade out for me.
Gotcha. But once again, it was a great introduction and a way to not completely lose your shirt. So exactly. I appreciate that it gave you that kind of taste of what that was going to be like. If that kind of didn't necessarily go the way that you were kind of planning, which you kind of admitted you weren't really too surprised, what made you say, you know what, let me dive deeper into this place rather than walking away?
Yeah, it was, there's so many different avenues, right? You can, there was the taxis, there's a fix and flips, there's, multifamily, retail, commercial, industrial. I always like building something, you use Legos as an example. I was really good at them. I liked them, but it's not hard to be good at them, right? There's a little book and it comes with the right pieces. So you just got to put them together. So the thought of being able to buy something, right, put it together and it be worth more or there was another use for it was always intriguing. And when I was in finance, it was throw a dart against the board, and let's buy this stock today. All the research in the world, it doesn't matter. You have no control over those companies, right? They're all publicly traded. You're a small piece of that puzzle that you're saying means nothing. You're basically going on a chart or a good article that you read. But also, I think you have a little bit more control, right? At the end of the day, it's your buy. There still is that, I don't want to call it speculation, but there still is analysis that goes in. So I just felt that this space gave me a lot more flexibility where my control, I was in that seat and I could have controlled what I bought. I didn't have to buy something simultaneously. If I knew I was buying something at such a great deal, I knew that I could mess it up really good and still come out on the finish line. Whereas if I thought Apple was at a great price, I can't control if the CEO decides he's going to get rid of the iPhone, right? Like that's out of my control, which could hurt or could help. You have no idea. This was a little different. So even failing at that, realized that, there's got to be some space in here where my creativity and my, my attitude and personality is going to fit.
Gotcha. So fix and flip wasn't for you necessarily. So what did we then do next in real estate?
So I became a real estate agent because investors don't make money right away. At least I didn't. And, I quit my job in finance and I was a real estate investor. That went horribly. And a couple months later, it's like, uh-oh, I need to get paid. So I ended up doing rentals and sales in the city in Manhattan. And while I was there, commercial real estate is what I thought I wanted to do. And I was doing residential stuff, which I despise because residential, if the color, I sold an apartment in Tribeca and the walls were a different color. And this couple had no budget. And I'm like, this is it, right? You want to live in this area. Yeah, I told them, if you buy this, I will personally paint your walls whatever color you want. And they ended up buying it. It was a great property, great deal for them. And I said, okay, I can't have people deciding whether they want to buy something or not based on the color of the wall. Those are things you could change. So commercial real estate's the avenue I went after, it was like 2 years or so doing that. It was, it was a hustle job. It's just, you show more apartments, you meet more people, you win, and you're only as good as your last deal.
Yeah.
On the commercial side was next. And my boss convinced me to do multifamily. And that's when I fell in love with multifamily.
Gotcha. So multifamily is in what aspect then? Now, is that when you crossed over to investor?
So when I was still doing the smaller stuff on the side, the tax deed stuff on the side, and it was very a part-time hobby, more or less. That was, fun. There was really cool stories, some war stories, but nothing crazy. Some crazy stories. But when I was doing the multifamily stuff, once again, you're an agent, you're a broker. You're really only as good as your last transaction. And for me, we sold the same building 3 times in 1 calendar year, 5-family building that, first guy bought it, got a tenant out, sold it. Next guy got 3 tenants out, sold it. Next guy got the last tenant out, sold it. So and I just saw that. I was like, wow, look at that. Now that guy that's going to own it, it's all cash flow, no more stabilized tenants, which that law's changed. But I saw that and I just started asking questions to, the buyers and the sellers, and seeing, a 65-year-old man or a 72-year-old woman that started in a pizza shop, coming from Europe, coming here, working as a busboy, and then buying the pizza place, and then buying the building, and then buying the 4 buildings next door. And that's how they've lived for the last 40 years. And I was like, oh, that's pretty cool, right? You have 17 apartments and a retail store, whatever it is. So I just started asking those questions. And while I was doing a fix and flip and I became better at it and buying some tax deeds, and there was money coming in where I didn't have to sell anything or buy anything or sell anything because I wasn't, that broker, you're still only as good as your last deal. If it's over. So after time being there and selling multifamily and realizing why multifamily made sense, I went out, I put an offer on a 48-unit property out in Ohio. And then that was sort of, 2013. And then the rest is, where I am today. Just fell in love with buying rental real estate, larger properties where you could add a tremendous amount of value by leasing it up or fixing down apartments or, fixing the deferred maintenance. So it was just a very easy transition after I got very familiar with multifamily, as a broker.
Then you made a very big jump there. You went from buying $300 tax deed properties in other states to making an offer on 48 units in Ohio, right?
Correct.
Could you just take us through a little bit about how,
flips.
you didn't just go for a duplex. You didn't go for a quadplex. You were like, you know what? Let's take that quadplex and multiply that by 12. I mean, what made you decide to go so much larger? And how did you even come across I don't even know what you would call a 48-plex.
Apartment building.
An apartment building, absolutely. But how did you even come across then something like that in Ohio?
So while I was, doing the multifamily stuff in Queens and Brooklyn, just like everything else, right? You type it into Google and something pops up. And I think I watched a webinar. It was, it happened to be Dave Lindahl, who's, an apartment coach type guy. And in the webinar, it said, send out direct mail to look for like a row house of, 3 families and like go online, go to the tax records. If there's an LLC that owns a couple of them, try and buy the ones that aren't and then call the LLC and sell it. I was like, oh, that seems simple. So I hand wrote like 700 letters and I did that. And
So
while I was
simple,
doing
just
that,
700 handwritten letters.
and it's
Simple.
actually, I'm pretty horrible at social media, but I think somewhere on my Facebook, there's a picture of pink and blue envelopes. And
Yeah.
that was not told to me. I just figured, okay, people see a pink envelope, they think maybe someone's getting, having a baby girl, and
You
a
think a
blue
card.
envelope, someone's, yeah. So I said, let's try it, right? That was just thought.
It's really smart.
And it
But I'm
worked
thinking a
out really
birthday
well.
card, or I'm thinking something that's
Exactly,
like
just
more personal rather than just junk mail. That's
exactly.
I like it.
So,
Okay.
and then you just tried that, and somewhere in that mailer, bigger apartments started coming up. So for me, the next logical thing was, all right, let's understand. I knew how to underwrite a 6-family, 12-family from my Marks and Millichap, learning phase. It's like, okay, New York landlord laws. When I was an agent, you heard the war stories of tenants not paying for 2 years and living there for free. And so I don't want to do that. So logically, it was states with more favorable laws. And then
Mhm.
my very good family friend, almost like an uncle, had a mentor that he said, just go talk to this guy. So I ended up talking to him, and he was the one that really took the just go do it type attitude and sort of honed it into, hey, we're buying in Cincinnati. And I was like, if you're buying there, let's buy somewhere close by, but not far away, just in case I need help. And then it's that's where I, learn, employment, population growth, job growth. Those are the things you look for. So Columbus, Ohio, where that
Mhm.
first building was, checked off all those boxes. The population growth was great. The job growth was great. There was no one, wasn't like a Pittsburgh with like steel, or it wasn't like a one employment city. There was so much going on. It just seemed like a logical place to mail and market and try and buy. So that was sort of the sequence. I had a family friend that helped me meet somebody that helped at least put me in the right direction. And then it was just
Mhm.
like that first tax deed property I bought. It's, hey, it's 50% occupied and half those tenants are paying. If I could just fill this up, it's worth more than I'm paying for it. So that's the approach that I took after getting a little bit of understanding and knowledge and education and reading and getting familiar with that situation.
Now, was that something that you financed personally, or that was this like a first syndication that you'd done?
So it was the first deal I did was syndicated. My
Mhm.
dad and a very good friend of mine to date signed on a full recourse loan, and I raised more or less about 600 grand. It was like 500 and change.
Okay.
We got an $800,000 loan. We were all in for $1.5 million plus or minus. It was actually a little bit less than that. And
Yeah.
in that price, we bought the building for $1 million or 900,000, and then we put in a good amount of work, leased everything up, and then we ended up selling it 18 months later. And
Oh, wow.
that was sort of just and then I saw that, and then from that period I just tried to get involved in any deal I could, whether it was help raise money, help finance it, bring capital to the table, whatever it looked like. So I just put myself in different situations and met a ton of people that were short, right? I don't have the balance sheet, I don't have the equity, I need something. I just put myself in those roles and just tried to buy as many properties as I could, because I really enjoyed doing that. I thought it was that business plan made a lot more sense than just a one house where if you didn't get your price, you lost. Here, there was tenants paying your rent, they were paying down the mortgage. You had all of those positive components where your forced appreciation was, if you get it occupied and you pay and you sell at the exact same cap rate or even at a higher cap rate, it's worth more.
Mhm.
You just got to make sure you don't put in more than what it's inevitably worth, which you have due diligence and time and learning. And from my experience of doing everything I did in the past, I had a much better idea on the physical costs of things.
Gotcha. You threw out a whole bunch of terms there that I'm going to
Yes.
break down, and I'm going to make you give definitions to. So, simply started, what is a syndication?
So that is basically a group of people coming together to buy something. You can syndicate, cars, multifamily, or real estate, business. It's basically a group of people coming together to buy something, whatever that something is. In this case, it's a group of people coming together, typically with one person running the show, buying a piece of real estate.
Gotcha. You also said, I'm looking at some of the other terms you mentioned, recourse loan. Describe
Yes.
that.
So the difference between loans are recourse, non-recourse, partial recourse. Recourse means that if you mess it up, they can come after you personally for the money, like a regular 30-year mortgage on a house. In the commercial world or in the multifamily space, and a lot of them, there are a lot of loans at this time. There were not as many because we were coming out of the recession. A non-recourse loan basically means if you mess up the project, as long as you don't steal, corrupt, do anything you're not supposed to do, you take the keys, you give it back to the bank, they don't come after you for the balance. The recourse side, that's the difference. You can mess it up, giving it your good old college try, but they can still come after you for the balance of the principal.
Gotcha. So which makes perfect sense, right? Like there is recourse, so there's no recourse, right? So in that non-recourse loan, then it's really that they're gonna go after the net property because clearly the bank still wants to recap something. It's not like the bank's gonna be like, good job, John, nice try, science didn't work out. We'll just walk away, have a good rest of your life. They're gonna say, okay, John, we'll leave you alone, but now we want that asset, right?
Correct. Yep. And
Right.
you're 100% right. They typically lend based on the value of the asset. And they look at the asset, you're like, okay, it's worth $1 million. We'll give you 500 grand, right? And if this goes horrible, we'll still be able to sell that. It's the same thing on the recourse side, where they're still lending based on the asset. But let's just say it's that same example. It's $1 million. They give you 500 grand, but it doesn't work. They're going to try and sell that. If they sell that for 800 grand, they're not coming after you because they got their money back. If they sell for 300 grand, they're going to want you to give them $200,000 back. So it's only in bad situations it becomes a problem. But obviously, anytime there's recourse, there's just more risk than if it's non-recourse.
Gotcha. Thank you for breaking those down. Now, when you had mentioned kind of that description of like what a syndication actually is. So, and I'm going to be playing kind of devil's advocate here. So does that mean that I can just call up 3 of my friends, say, hey, let's all put in 100 grand and let's just go buy a property? Would that then be a syndication?
Yes.
Thank you.
It would definitely qualify. I mean, that's the fancy, sexy term, right? It would, that's, but yes, that would absolutely qualify.
Gotcha. Okay. But let's switch that up a little bit then. Let's then say I go and I say, you know what? I don't really know a lot of people that have $100,000. So I'm just going to go and I'm going to take $100, just $100 from a couple thousand people to be able to buy a property. Is that still a syndication?
Yes. Not something I would recommend, but yes. It's, the more people involved, the more emotions, the more obviously, people you're dealing with. But yes, the answer to that is yes. As long as there's a transfer of control for a membership with a group of people, I guess it could be a group of anybody. It doesn't have to be people. A group of people giving you money. Yes, that would be in my understanding and what I would qualify as a syndication.
Okay, the difference of those two questions I just asked will be shown for why I'm asking them now later on in this podcast. But so now we end up buying this 48 unit over in Ohio, and it sounds like that really just kind of found you the right model of what you really wanted to be involved in within real estate investing, right?
Correct.
So now we got that 48 units. You were able to raise capital. You found some other people that also kind of went in on this with you. After now that first property, what do you do next?
Yeah, so you figure out what you did really well, and you try and go find that property in a similar market. And that was basically the business plan. I basically said, okay, I sent out a lot of direct mail. I did a lot of cold call from prior jobs, and that's what I was good at. So I said, okay, this is a very broken property in a very good area or a very good market, maybe not the physical location. Let's go try and find that at scale. Let's go do that 2, 3, 4, 5 more times. Each time, whether it's a little bit bigger, or a little bit heavier lifting, or whatever it looks like. But it checked out the boxes. It was, I don't want to say fix and flip on steroids, but there was 20 units that were vacant, right, and that needed work. So the difference between a house is that it's one house, one kitchen, where you're appealing to the personal side of someone buying a house. Here, it's not necessarily the personal side. It's 48 kitchens. So you need 48 appliances, all the sets. So you can very easily calculate that. And typically at scale, you get a little bit more whether it's a discount, you get economies of scale at scale. So I knew if I had 20 units, if I went to the store and I bought 20 sets of flooring or 20, multiply the square footage, it would work. So it was basically fix and flip multiple places at once under one roof or under two roofs, whatever the size of the building is. And it was in one location. So you basically could put all your, I don't want to say all your eggs in one basket, but everything was there. So you had, your guy would renovate a unit, go to the next unit, go to the next unit, you didn't have to worry about crews running all over the place, going to one house and the next house and not showing up, or not getting there on time because there was traffic and they missed the deadline. Here, everything was done at one property. So it was like, okay, 48 units, why not 200? Why not 250? It's the same thing, just bigger. So it was, I did that really well. Let's go do it at a larger scale.
Gotcha. So then that really became your niche, was working within syndications itself.
Correct. I always knew I wanted heavier lifting projects because there's typically people sell them at a discount because there's a problem. They're easier to find that there's a problem because if everything in the area is 97% occupied and your building's 50, well, why, right? And that's the first question you ask is, what's wrong with this? Oh, these units they're down. They're not online. You can't rent them. They're, to the studs. That's an easy fix, right? You know exactly what you have to do to get it up, to get it occupied. And in this space, it's all, these things sell like equity multiples or a cap rate, which is basically the percentage of value if you pay for it all cash. So it's very easy to calculate. There's no emotion in it. It's a numbers game more often than not, although the last 18 months, 24 months, maybe it's more emotional than it ever has been, but it's basically math. I mean, it's simple. I know it's going to cost me X to fix this, and I know it's worth Y. So you try and find problems in good areas, and if you fix the problems, you typically get compensated for that.
I find it really interesting that you kind of started with these flips for just like a couple $100, and you kind of said, it didn't necessarily go that well, but I learned a lot. And it's kind of interesting to see that you clearly then ended up using those skills later on. And that's clearly going to help you now when you talk about 48 kitchens. I'm quite sure that's something that you would learn years before actually ended up coming full circle for you.
Exactly. And typically on the bigger projects, you have a better quality of contractor, better quality of manager. You're dealing with just, it's not the guy that you met at Home Depot that's a plumber that's probably not going to show up. There's typically a little bit more qualifications that, it's a bigger project. So they typically, you can find better resources, better management companies that have better resources. So you take that small deal that, I bought a house in Philadelphia for, $1,800, and you knock on the door and it's a disaster, right? There's no floor, there's no roof, there's a tree growing through the kitchen. And I'm like, now I got to go find one individual or a company to fix it. A company fixing a house is going to cost a lot more than an individual. Risk reward. Here, you take that exact same skill set and you apply it to a much larger project, and it typically goes in a better way. So yes, what failed miserably as one-offs works really well at scale.
Absolutely. And also any problems that you have kind of get a little bit more divided up between things then can go right? When you do that first unit, if you run into problems there, you have the opportunity to fix it before going to the next one versus house number one versus single family house number two, which are going to be completely different anyways. So you can kind of continuously even be improving within the project. Now, do you tend to stay in the same markets when looking for syndications?
So obviously, there's a lot more single family houses in the country than there are buildings, and there are a lot more 48 unit buildings than there are 500 unit buildings. So the perfect world, yes, if you can find one market that you are intimately familiar with, stay there as long as you can. But as you scale, as you grow bigger, it becomes more geographical. The regions are a lot larger. So where if you're really good at fix and flip, you might only work in 1 or 2 zip codes in your backyard or in another state. Here, one zip code is probably not going to have enough buildings for demand. So you start off 3 or 4 market, maybe you pick 10, you find the 3 or 4 you like, and you try and operate within those 3 or 4. And then as you get better, as you do it more, you can go regional, Southeast, Midwest. So we've been in markets from basically North Carolina down to Florida, as far west as Alabama and Mississippi, and then as far north as Ohio. And we do have an area that we do more, it's that Southeast and that Midwest West regions that we typically like to stay in. We are also looking at the markets that everyone else is, the high growth, where everybody's moving now. Everyone's moving south and, to the West Coast. They're moving to, Arizona. So they try and track migration patterns and job growth. Typically multifamily there's 3 rules. It's population, jobs, supply and demand. If you check those 3 boxes off, you pretty much, it's very difficult to lose as long as you buy them right. But where jobs are, people will go. Where people go, there's a demand. As long as the supply is not outpacing the demand, you should be in good shape. Obviously, COVID has made that job growth a little different because now people can do a lot more stuff remote. But population growth, job growth, and supply and demand are more or less the only 3 things that you have to understand to find a good deal. And that's not just multifamily. That's retail, single. That's everything, right? You know, if
Real
people are
estate in
moving
general.
there, yeah, that's real estate in general. So, but those 3 things are the things that we look for in new markets or developing new markets. Let's see what's going on historically. Let's see what's happened in the past. Let's see what happened in 2008, 9, right? Like what happened when the world came to an end. So we look for all those things. And then because we've done it so many times, you build relationships with regional managers and national managers and stuff like that.
And I was just going to ask, like, is that, not to give away all your secrets here, but is that how you really look into those markets, is through networking connections that you have in those areas?
Yeah, that's definitely one thing. I mean, if you don't have a management company that understands your business model, like if you buy a lot of C-class properties that are heavy lifts and you're using like an A-class high-end manager, it probably won't work. So you want to, where your manager works and what they know, if you really like them and you get along with them and they're really good at it, try and play to their strengths, right? If they're really good at heavy lifting projects, look for heavy lifting projects, right? But that also goes back to your appetite as an investor. What do you like to do and what do you like to see yourself involved with? And then find the team around you that can add value and not, hurt you.
Do you ever feel like you end up in like a chicken versus the egg scenario where you kind of need the property manager to find the building, but you kind of need the building to find the property manager?
Yep. So this business, you're always in that chicken or egg. That I think that's real estate, right? Because you might, I joke around people when they say, how do you pick a market? Okay, what's your favorite vacation place in the world? Oh, I want to be on a beach in California. Okay, fine. Look at all the beach towns and see if there's any value there. And then look for the manager. Now, well, how do I buy something if I don't have someone to manage it? Well, then look in your backyard and see if you can manage it yourself. So you got to, at the end of the day, pros and cons, take out a piece of paper and write the pros and cons of each, and then figure out that space that you want to operate in and say, okay, I like these 3 markets. I'm going to go find 3 managers and I'm going to build around it. So yes, but you gotta pick up a horse and ride it. You can't just expect it to be delivered to you. So yes, but you're always in that position. I mean, even to date we are. You're always thinking about, should we do this first or that first? And conceptually, you almost got to run them simultaneously.
Now, in case any of our listeners are looking to actually get into syndications and to be the person finding the properties and kind of putting all this together there, what advice would you have for somebody that's looking to really get started building a syndication business, not as an investor, but really as that sponsor side?
Become an expert. And that could be whether you live in a market and you're an expert in another one, or whether you live in a market and you're an expert in that market. That we just had a conversation. We were talking about a buddy of mine. He is so intimately familiar with the town he lives in. He knows of things getting approved before they get approved. So of course, if he finds a piece of property that he knows the zoning is going to change or something like that, it's a home run all the time. So if you want to get involved in this space, you either have to be really good at that and knowing your market and knowing where, a divide line is, and you don't want to be on this side of the church. You're going to be an expert in an area, or the truth be told, you have to have a lot of money where you could call up individuals and say, hey, I can fund this deal. Let me be a partner, right? So those are the 2 things. But my recommendation for those who don't have a blank checkbook is become an expert where you can add value to someone that needs it. You could be boots on the ground. You could, of new developments and new locations and deals for sale. But if you are an expert in an area, you will absolutely be able to syndicate deals or find deals, so on and so forth.
So also kind of a situation where you're probably kind of on both sides here with the chicken and the egg, is then you're looking for the next deal, the next building, but then you're also looking for investors that are going to now be a part of that. How do you go about then finding investors to fund your projects? So
2 things. One, start your investor hunt today. You have to run that wheel simultaneously as well, right? It's always deal flow. It's always investors. If you had to stop one wheel for a second, stop the deal finding wheel and do the investor side. Because when you find an investor, you can't just go to a networking event run into someone and say, give me $1 million, I found a deal. It's cultivation. You have to start today for the deal you find in 24 months. So you talk to someone today, you put them in an email follow-up, and not a spammy, I'm going to email them every day like I'm selling, some Amazon product. It's, you have to educate them on why they should invest with you and what you are looking for and why you are an expert in your field. So you have to cultivate your investors today for the future. That's probably the biggest mistake, or any syndicator will tell you he wish he started earlier, because when you have a great deal and you beg for money, you're gonna give up a lot of the deal. When you have a great deal and you have a cultivated group of investors, you could almost dictate your terms. So those are the two wheels you spin, and that's just, like I said, networking, coffees. The easiest thing you do building your investor database, starting right after you listen to this podcast, take out your phone, open an Excel sheet, A to Z, every single person in your phone, and a potential dollar value. I don't care if it's an ex-boyfriend, an ex-girlfriend, an old boss. It doesn't matter. Put them in there, and then you got to reach out. You got to get their email. You got to take them to coffee, dinner, lunch, breakfast, wherever you can. But get out in front of that today. But those are two things you're spinning. That's why, if you either be really good at raising money or really good at finding deals, if you want to do it both, time block your calendar. Make sure you're getting 5 meetings a week. One goal that I had is meet 30 new people every month. These were
Nice.
in the pre-COVID, the networking days, and even post-COVID now, or post-COVID, but 30 people every month over the course of the year is 360 new contacts. If they each give you $1,000, do the math, right? Now, if some guy gives you 50, 100, 200, it can scale quickly. So my goal early on was minimum 30 people a month. And that's not just going to a networking event, getting a card, putting it in your phone. That's going to an event, getting a card, emailing them after the event. I don't care if it's 1 in the morning. Hey, great meeting you today. Are you free in the next 2 weeks to grab a cup of coffee or a dinner? It's 30 new sit down, 45 minutes to an hour meeting. And not, this is what I do, I want your money. Hey, how can I help you? What do you need? What are you missing? Be that person of value in your sphere. And that's the easiest way to either find a deal. And that's life. That's not just real estate, but in this particular space, that's what you got to do. You got to run both those wheels all the time. It's, 30 people a month. I want to underwrite 30 deals and go full systems go.
No, I love that. We actually do have, for any of our listeners out there, we do have a couple episodes that you can go back and take a listen to. One of them is all about cold calling and how to approach people that are new within your life. And we also have an episode with Adrian Miller all about networking and how to stay in contact with them. Like John's talking about, how to make sure that you're always providing value to stay in front of those people. So if you've not listened to those episodes, make sure to go back and look for our cold calling episode and also our networking episode. But I love the idea of what you actually said there, John, about starting with the people that are actually in your phone. We all have thousands of contacts. I have had a cell phone for more than half my life by this point. I have thousands and thousands of people. My ex-boyfriend will probably not be on my short list of people to call. But in general, to start with the people one is going to be a little bit less stressful, a little bit less awkward. And one of the biggest points that I'll at least share from a networking perspective is to also think about, instead of just selling to the person in front of you, to think about selling to the people that are behind that person. Meaning, if I'm going to call up my old buddy John here and talk to him about a deal I have, great, I'm going to see if John's interested. But even if John isn't, I want to see if John knows anybody in his network and his thousands of people in his phone that might be a good fit for me. So it's a great idea to be able to continuously build those relationships rather than just shooting yourself in the foot. Cool, John says no, I guess I'll never talk to John again and he's useless to me and we'll cross his name off. There's always other people that John may know that could still be a fit for me. So it's not just those thousands of people in your phone book, but now we can literally multiply them by tens of thousands. It's kind of cool.
I think the easy question for anyone, right? You call your ex-boyfriend or your ex-girlfriend, they're not giving, that's not where you start, right? You start with your brother, your cousin, your aunt, your uncle. But when you get down that line, it's very easy to say, hey, if you know anyone that is interested in something like this, do you mind making an introduction? Or do you think this can help anybody? Or do you think if I can add value to anybody,
Correct.
let me know, right? Like that's networking at its finest. Calling up someone that you haven't spoken to in 20 years, telling them you need 50 grand for a deal, I rest assured your success rate is going to be virtually non-existent.
Correct.
But, you call that person up and say, hey, we haven't spoken in a while. I saw on LinkedIn or I saw on Facebook, let's get a coffee and catch up. You can't tell that person that you're raising money and you need money, or you're looking for real estate deals. It's got to just be a casual, hey, we met up where, hey, it's been nice to see you. I saw you live here, or whatever. You can't ask for things right away. You have to present
Right.
opportunities, and you have to go through that thing. So I agree with, with Becky 100%. You gotta start somewhere, and it's not just the person you're talking to. It's every possible person that they know that you think that you can help.
I also appreciate that you mentioned, like, not to get discouraged if all of a sudden somebody just kind of says no, like the first time. Some of our listeners know, if you did listen to the syndication workshop, that John and I had actually met back in 2018, 2019. I think it was the end of 2018 there. And we'd stayed in touch. I was in John's email list for quite some time, always kind of kept back there. And when my husband and I decided that syndications was really something that we wanted to revisit, John was still on my short list of people that I wanted to talk to about investing my money with, because I remembered his name and I saw what he was still doing, and he continued to be active in my life. There were probably 100 other sponsors for syndications that had contacted me over the past 4 years that had wanted my money, wanted my business, that I never heard from again. So when I was then ready to move forward with investing my money, the person that I called was John. So it took us a while, but once again, that's what you're saying about kind of that relationship building and making sure to stay in front of people. And all of a sudden things will start to kind of come back full circle, even if it wasn't a win on day one, chances are there's a greater success in the long term. So
one thing that I did, I probably could find it. It was an Excel sheet, nothing fancy. It was names on the side and dates on the top. And if I posted something on Facebook or Instagram, everyone that liked it, I would go, what's today, May 16th. So May 17th, I post something and I have 100 people. If Becky hit like, I put a little check box in it. And when you do finally have some longevity behind you and, 3 or 4 months of data, you start with the people that have expressed the most interest in liking you. And that, like you said, it's just how many times did this person open this email? How many times did this person reach out? How many times? And the more they've reached out, start with that, because they're obviously more involved than the person that never looked at it. So that's just one tip that, it goes along. It's a long term. You got to start today. That's what I said. Start today for something that you're going to do in 24 months.
Exactly. I can't tell you how many times I've had ladies reach out about the Lady Landlords mentorship program that I've just kind of said, like, hey, I've been watching you. I've seen what you've been doing. I've been liking your stuff. And I'm like, yes, I see you. And when it's then the right time, then they reach out to me and say, hey, okay, I know what you do. I know what you could do for me. Let's move on that. So when I reached out to you a couple months ago about wanting to move forward and invest for the syndication, there were just things that had changed in mine and my husband's portfolio in life that just, it made sense for us. At that point, when we talked to you years ago versus now, our portfolio has really grown quite a bit. We have a lot more properties now. We self-manage a lot more of those properties as well. And we were just really looking for something to kind of diversify our portfolio. Would you say that a lot of the people that you talk to are coming to you from a time perspective of looking for another place to put their money? Are they investors that invest somewhere else and want to diversify? What are the typical people that are coming your way?
So it's definitely a mix. That's probably something we should do a better job at, finding a niche of who our investors are. We have the full walks of life for sure. I would say there are, if I took those individuals, just broke them down just by what I know, most people want more time to do what they want to do, and they don't want to focus on this part of their portfolio. That could mean whether they're already in real estate and they might buy self-storage and they need a multifamily guy, or they might be in real estate and they just looking for a place to put their money. But for sure, I think it's that's not what I do. I'm not an expert / diversification. I got to find my person.
Gotcha. So for somebody like me that then says, okay, I want to go towards syndication. I'm looking for something a little bit less passive, something I don't want to have to go buy 48 ovens and go find 48 different floor tiles, right? When I'm looking for a syndication, what is something that an investor like myself should be looking for? And how do I even find syndicators?
Yeah, so I think the biggest thing you want to look for is, it's skin in the game. You don't want someone that's going to be, buying multifamily and then trying to sell you a cryptocurrency course the next day, or you want them to be pot committed to whatever they're doing. That's the biggest thing that I would preach, right? You don't want someone putting no money in and, preaching how you can do all this with no money. That's probably not true. Where you find them, just like anything else, go through your network and ask the questions. Where can, do you know anybody that's doing this? Do you know anybody that, has an opportunity? Something like that. There's also, if you Google it, it'll give you 1,000 different websites. And then it's just a matter of fact check. There's a ton of companies online that are just down the fairway. Give them $5,000, right? And let them go to work. But you just want to vet them. And that vetting process is, you want to understand who the jockey is, not the horse, because you're betting on the individual, not on the property. The property, a good sponsor will make a bad deal good. A bad sponsor will make a great deal horrible. So Google it, reach out to your network. At the end of the day, there's a level of trust. You find someone online and you give them money and it doesn't work and you didn't vet them, shame on you. Someone through your network, there's probably going to be that trust barrier that's a lot easier to get over.
Now, one thing that I find very typical, for better or worse, within speaking to people about syndications is typically what happens with, once again, not with you, but with some other people that I spoke to, is that automatically you get kind of introduced to somebody and then you just kind of get like a slide deck, right? Or they take you through like a presentation and they're like, and once again, it's just filled with a bunch of numbers that maybe don't make sense, with a whole bunch of abbreviations, which make even less sense than the actual numbers that are next to them. Is that standard practice to just be like, sure, yeah, I'm looking for 50K. Here's a PowerPoint presentation. Call me back if you want to write a check.
So that's happening a lot more now than ever before because there's so much capital chasing deals. So there's a lot of groups out there that I'll say they have a head of investor relations. It's probably a virtual assistant that just answers frequently asked questions. It's harder today because, like I said, there's just so much capital chasing deals that it's easy to just stumble across that. Definitely not the group that you probably want to. And you want some type of you want some type of interaction with someone that you can ask questions and not just rest assured that frequently asked questions, if you're one investor in a group, they've had that question asked before. So they have all the answers ready for you. So you got to try and think of a question that's not typical. I mean, it could be as crazy as, how many kids do you have, right? Like, not typical question. It could be 0, right? It could be just completely outlandish, but you want to try and get the answers to questions not that are just so programmed that could just be automatic, because a lot of that is, like you said, here it is. Here's a 30-page book. That's all I'm giving you. Say yes or no. Well, if you really like the deal, go for it. I'm not going to tell anyone not to do it, but make sure that you're comfortable with that answer. And if you're not, I wouldn't do it. If you are, go for it. You got nothing to lose.
I like how you said it's kind of almost more important to evaluate the sponsor, right? The person that's going to be kind of running this project, running this syndication, rather than the actual syndication first, right? I feel like as an investor on my side, I need to look at both. But what I really hear you saying is, let's start with the person, right? Not just by asking those questions, how many kids you have, about like, hey, how did you get started investing, those types of things. You're kind of weeding out the people that are just kind of trained salespeople that are just going to read off of the slide and just repeat information. What you're really looking for is someone that kind of knows the ins and the outs and making sure that they're aware of what that syndication actually involves to really protect kind of the investor's money.
Yep. I would also ask how long have you been doing this? Because I'm on, I get 25 emails a day on all different types of sponsored deals. And I go through the process with all of them. I go to I schedule a one-on-one call and I find out what they're doing and how good or bad it is. If they do something, I was like, wow, that's actually great, I should incorporate it. Or they do things that are just, you can tell. So I'm weekly going through those one-on-ones to understand what the market's doing today, so how I could set myself apart. So I think that if you have any intention of ever investing, go through them, right? Go, sit on their call, fill out their webinar. You don't have to watch their webinars. You can typically just get a one-on-one call, but go through that process, because you'll see 10 people. And if they're all carbon copies of each other, that should make you ask, is this standard? And then you get that one weird guy or different guy and and they're, oh, that girl's a little strange, right? Well, why? Is it just because, they've been doing it longer, or they know, or I'd rather see that than just a prototypical stuff. So you have to go through this cycle a couple times before you pick and choose what you love, what you don't.
And actually, I've been in situations where I've had different people that, to my understanding, seem unrelated, send me the same deal.
Yep,
That's
that
always
happens all the
interesting.
time.
So I want to do now round two of John defining terms within syndications here. So we talked about sponsors, you see GPs, LPs, fundraisers, like all kind of come up in this world when you're kind of getting like these emails or trying to reach out to people to learn about them. Can you tell me first, let's start with sponsor.
Yes, that's basically that should be the person that's in control. Sponsor, general partner, GP typically should be the person in control. The general partnership or the GP could incorporate a couple other people, but that should be the group that's running the project.
Gotcha. And what's an LP?
An LP is a limited partner. That's someone that's probably going to be passive. Not going to say much. They're going to write the check. They're going to be the investor. They're going to get the reports. They're not going to have much say. Now, keep in mind, one thing you should see on the GP, people say they're part of the GP or they're on the, when they say stuff like that, how many are on the GP, right? Are you just raising capital? Are you actually making decisions? Those are things you want to understand.
Right, because there can be people that do both. There can be people that are really just raising the money to then invest in a certain property versus people that are actually a part of like the managing team and the really kind of finding that like project to start with, right?
Correct.
What are some big red flags that should scare me off as an investor looking at certain sponsors?
Money where your mouth is, for sure. 2 would be, is this what they normally do, right? If they're normally buying Class A deals and now they're buying a C-class deal, or vice versa, although the vice versa is a little bit easier to do. Location, is it a new market, a new deal, or like a new deal in a new market for them? They've never been there. Now, if they're buying in Jacksonville and the deal's in Tampa, you can get over that because that's fine. But if they're historically only bought in Florida, now they're buying in Ohio, understand it. Liquidity and capital of the general partnership, because if something does go wrong, yes, all the investors could have to pony up money, but make sure the sponsor is pretty financially okay for the type of deal they're doing. Those are the big things that I would expect anyone to want to know.
That actually is great because that kind of gives me what you should look for and what you shouldn't look for all in one answer. So that's really helpful. One of the other things that I think scares a lot of investors away is the term accredited investor. I feel like you could see all the time when you come across syndications, they automatically like, oh, but this deal only for an accredited investor. How would I know if I'm an accredited investor or not?
Once again, if you Google it, it'll tell you exactly the qualifications. It's changing. This space is changing. Accredited investor is not changing much, but basically an accredited investor is you have a net worth over $1 million, not including your house, or if you're single, you make a certain amount of money. If you're married, you make a certain amount of money. Those are really the big ones. So you can easily figure that out to see if you are or you aren't. And then obviously some deals you have to be an accredited investor, others you don't. Just depends on who the sponsor is, the level of risk, how much they're raising, how much money they're raising, so on and so forth.
Because this was something actually, and this kind of goes back to my whole example of if I could take $5 from a bunch of people, or if I should take $1,000 from a bunch of people, right? $10,000 from a bunch of people. Because one thing that I feel like I've learned looking into syndications more and now investing in syndications is that it's not just as easy as it sounds. There are actually a lot of laws and guidelines that need to be followed. That I feel like people really look at the sponsor to kind of keep us in check about what can and cannot be done within syndications. Is that accurate?
Correct. So the more accreditation that's needed, and if it's only for accredited investors, it's typically a level of risk that the sponsor doesn't want to get. The more, it's like anything else. The government, the SEC, they don't want people just going to take advantage of people. So the more money you raise, the more there is. But yes, it's on the sponsor to accreditate the individual, not on the individual lies. Shame on them. It's really on the sponsor to really make sure that the investment's right for the end investor. Now, that's one of the other flags I'd look for. If they're just taking anybody, understand why. But yes, that's it's on us to make sure it's right for the individual. At least it should be.
And that's also why there's more of a conversation that usually takes place, or a slide deck, rather than just, hey, here's a link, go just,
Correct.
wire the 50K here. There's usually a conversation first before that gets to it,
Correct.
because it's really then a liability for you as the sponsor. So if anybody is just saying, hey, just send me money, that's a huge red flag that you can watch out for.
I would agree with that.
All right. So now I've gone through as an investor. I realize this is right for me. I've talked to the sponsors. I've now looked at the deals. What is usually the way that somebody gets started?
It's time to write a check. There's a bunch of documents, and make sure you're familiar with it. But after everything, you're good. A physical investment. You're gonna get in there. You'll be an investor. You'll see investor relations, presentations, updates on the deals. That's the next logical step, is to do it.
Gotcha. And then it's time to kind of get started. And the idea is to sit back and be able to collect some of those checks without having to worry about fixing toilets, right?
Correct.
Gotcha. All right, well, good. Well, John, thank you so much for joining me today. I really appreciate it. For any of our listeners, if you have not seen our workshop on syndications and would like some more visuals to go through and kind of talk more about some of the deals that could be a fit for you, do make sure to check the show notes down for the link to go back and watch the syndications workshop that John and I did a few months ago together. Otherwise, do make sure to, as always, subscribe wherever you listen to the Lady Landlords podcast, either wherever you listen to podcasts or on our YouTube channel, as we release new episodes every single Tuesday. Thanks so much, and see you next week for the next episode of the Lady Landlords podcast.
Thank you for listening to today's episode. If you're feeling stuck in your real estate journey, visit lady-landlords.com/roadmap to book a one-on-one workshop with me. I'll help you determine your next best strategy. Or you could subscribe to our newsletter for exclusive tips and offers. Invest with confidence. Become a lady landlord today.